Ladies and gentlemen, dear colleagues, on behalf of the academic community of the Athens University of Economics and Business, I would like to extend a warm welcome to all of you attending this important online lecture by Professor Philip Lane, member of the Executive Board of the European Central Bank. This is an event organized by the Department of Economics. On behalf of the university, I would like to welcome Professor Lane and thank him very much for agreeing to give this lecture. Professor Lane is one of the most prominent policymakers in the European Union, but also a very distinguished academic economist. He is the European Central Bank's chief economist. He previously served as the governor of the Central Bank of Ireland from year 2015 to 2019. Professor Lane received a doctorate in economics at Harvard University in 1995. He then became assistant professor of economics and international affairs at Columbia University. From 1995 and onwards, served as professor of international macroeconomics and director of the Institute for International Integration Studies at Trinity College, Dublin. He remains affiliated with Trinity College as professor of political economy. He was a research fellow of the Center for Economic Policy Research and has been a visiting scholar at the International Monetary Fund and the Federal Reserve Bank of New York. His lecture will be on the resilience of the euro, an extremely important topic for Europe and Greece, especially after the crisis of the last 10 years and the recent pandemic. The event takes place in a year marking the 40th anniversary since the accession of Greece to the European Union and the 20th anniversary since its accession to the euro area. It also takes place in the context of the new policies agreed at the European Union's context, in the context of the Recovery and Resilience Facility, which will make 672 billion euros in loans and grants available to support reforms and investments undertaken by member states. The aim of the facility is to mitigate the economic and social impact of the coronavirus pandemic and make European economies and societies more sustainable, resilient, and better prepared for the challenges and opportunities of the green and digital transition. Dear Professor Lane, let me personally welcome you to the Athens University of Economics and Business. Once again, thank you for agreeing to give this online lecture on a topic that concerns not only the academic and policy-making community within the EU context, but far beyond it. I would like now to give the floor to Professor George Alogoskoufis, the head of the Department of Economics. Professor Alogoskoufis will provide more details about the structure of this event and will moderate the discussion that follows. Thank you very much.
Thank you, Rector Bourantonis. On behalf of everybody at the Department of Economics, I would like to extend a warm welcome to those attending this very important online lecture by Professor Philip Lane and welcome him to our department. Our department is the oldest department of economics in Greece. It was established almost 100 years ago, and it has had a pioneering role in organizing both undergraduate and postgraduate studies in economics in the last, especially in the last 40 years. Our graduate programs already started in 1978. Let me briefly introduce Professor Lane, although he's extremely well known and Professor Bourantonis said a number of things. As the rector said, Philip R. Lane is one of the most important policymakers in Europe, but also an extremely distinguished academic economist. His 2001 paper with Milesi Ferretti on the external wealth of nations, which was published in the Journal of International Economics, is one of the classics, I would say, of international macroeconomics by now. It has affected both the theory and the practice of measuring the external balance and the external wealth of individual countries. And it is one of those rare papers which was published twice. It was published again in an updated version in 2007, again in the Journal of International Economics, which is a very rare feat. He also wrote an earlier paper in the American Economic Review in 1999 on the voracity effect with Thornell, which is an exemplary political economy analysis of how the struggle between social groups can reduce economic growth. And of course, in between and since then, he has produced many other important academic papers, including one of the earliest analysis of the European sovereign debt crisis in 2012, published in the Journal of Economic Perspectives. Now, in the last few years, Professor Lane has moved on to become a prominent policymaker. He's currently the ECB's chief economist, and he previously served as the governor of the Central Bank of Ireland. Today's lecture on the resilience of the euro is based on his most recent research, and it's extremely topical, especially after the crisis of the last 10 years and the recent pandemic. And we are looking forward to your lecture, Professor Lane. Now, this event is even more topical for us Greeks because, as the Rector said, 2021 marks the 40th anniversary since the accession of Greece to the European Union and the 20th anniversary since its accession to the euro area. So, Professor Lane, let me personally thank you for agreeing to give this online lecture and for choosing a topic of interest to the academic and policymaking community. We shall listen with extreme care, and after the lecture there will be some remarks and some questions initially from some members of the department, Professors Louri, Sakellaris, and Vettas, and also some other members of the department have expressed an interest in putting some questions. So the floor to Professor Lane, please.
Okay, thank you very much for the invitation to present this lecture. And of course, although the online world is amazing, it's no substitute for an opportunity to come to Athens. So of course, that's my regret. I would say that this topic of the resilience of the euro and this paper that I've written maybe crosses over some of the different areas that were mentioned in my research background, because to understand the euro, it's definitely a topic in international macroeconomics in terms of how a 19-country monetary union works. But it's also very definitely a topic in political economy, that's for sure. So if you can move to the next slide in the presentation. So what I say today, for those of you who want to know in more detail, is this paper, which basically I wrote between last summer and the early part of this year, has just come out in the Journal of Economic Perspectives. So that's a free download, and the web link is there. So I'm going to try and give you the highlights rather than every last detail. So as was mentioned, in fact, in the Journal of Economic Perspectives, this is the third time I've come to trying to write about the economics of the euro for, if you like, an international audience. So I wrote a paper in 2006 on basically the entry effects, how Europe was affected by the introduction of the euro. Then in 2012, I wrote about the sovereign debt crisis. And I think it was timely to come back to this question now. And one of my maybe basic points is many people had strong views about the euro in the 1990s before it was launched. So there were lots of very interesting discussions about what the euro might look like, what would be the potential gains, but also what were the risks. And then, of course, when we encountered the global financial crisis, and then we encountered the European sovereign debt crisis. And of course, on top of that, the very severe individual crises affecting particular countries. And of course, that includes the Greek experience. There were many papers written about what were the interconnections between these crises and the euro. But here we are, it's 2021. It's years later, I mean, depending, of course, which crisis I'm talking about. And that's, when I started this work the idea was, well, let me see, do we need to update our views about the resilience of the euro? And so compared to the pre-crisis period in the first decade of the euro, but also compared to the crisis years, which I kind of loosely categorize as 08 to 2013. So one basic question was, what did we learn from the post-crisis experience, which from a grand euro area perspective, I labeled 2014 to 2019. Of course, that's not to exclude the individual crises still ongoing in some countries. And then with the pandemic, there's been a new era, I do think, starting last year. So that's a basic question is, we should not think of the euro as a single episode, these 20 years. It's very important to allow for structural change across these different periods. I would say that's not only to do with the euro itself, it's to do with the fact the world has changed in those 20 years. So the rise of China and emerging markets in general is a big fundamental change in the world economy since the late 90s. And for monetary policy, a pretty fundamental change is the fact that the equilibrium real interest rate globally has trended downwards. So I don't know your own recollection of the interest rates you might have paid on a mortgage, for example, in the late 90s versus the interest rate, or from a sovereign point of view, the interest rate a sovereign would pay on a 10-year bond in the late 90s versus the interest rate today. And that's a huge impact on the dynamics of the euro. It also depends, when you think about the monetary regime, on what type of shocks are hitting the economy. So clearly a common currency, a common central bank is a better match when there are common shocks affecting all of Europe in the same way. And of course, the pandemic, broadly speaking, is like that. Whereas, of course, in relation to asymmetric shocks, when different member countries are hit by different types of shocks, or hit by a shock which has opposing effects in different parts of the euro area, then there's a limit to monetary policy, and then the overall coherence of the euro area requires other policies. So, this other factor beyond the fact that the structure of the world economy and the nature of the shocks hitting Europe has changed over these years, there's also been structural change. And in the paper I go through in particular, all of the architectural changes that came about as a result of the sovereign debt crisis. So, 5 years later, so at the time in 2012, 2013, there might have been questions, well, are these architectural reforms going to make a difference? And I think by now we can offer some initial thoughts about whether the architecture put in place has made a difference. And then, of course, while I was writing this paper last summer, the start of this paper last summer, we also had a new regime change of next generation EU, which is a pretty fundamental change. So what I do in the paper is I look at the post-crisis macroeconomic dynamics since 2014, and then I also look at the initial evidence about the pandemic. So the pandemic posed a new test for the euro area, but of course, the common shock test is quite different to the test of asymmetric shocks. But my overall conclusion is going to be that we've seen improved resilience of the euro area. So the resilience of the euro area is not a constant. The vulnerabilities that were much discussed in the 1990s and discussed again during the crises, the answers are different now, given all of the architectural reforms. And behind that conclusion is maybe a deeper conclusion about the political economy of the euro. What is it that has made the level of commitment so strong, both in terms of the collective European resolve to make pan-European reform, and of course the determination in individual member countries to make adjustments, quite deep adjustments, whether in terms of adjustment programs or adjustments to domestic policy making in relation to the euro. Now, of course, I would also conclude that it's important not to be complacent. Even if resilience has improved, I think we can collectively understand that the agenda is far from finished. Okay, next slide. And so one basic section of this paper basically tries to make the point, if you just basically ask, has there been a stabilization of macroeconomic performance after the crisis? I captured this in different ways. Maybe I'm trying to do too much in these graphs, but the left side of this graph shows you the distribution of GDP growth rates across countries over different time periods. And the basic message is, after the crisis, not only did average performance improve, there was a bounce back, but the distribution narrowed. So the very wide distribution of outcomes that was evident during the period of large imbalances in the first decade of the euro, the even larger distribution of outcomes that was evident in the crisis between those countries that were hammered and those which were not. After the crisis, the range of outcomes narrowed quite a bit. That's important because asking a monetary union to deal with very extreme differences in economic performance is demanding. This is purely descriptive. I don't say this is optimal, that everything is perfect. It's just descriptive that the range of outcomes narrowed. On the right side of the same chart, I show inflation outcomes. And maybe there's two messages here. One is the range of outcomes did narrow, which is again in line with the range of outcomes for GDP. But what's also true is the average drifted down. Now, we know we've been in this low inflation regime in the last 10 years. And both facts are relevant. The narrow distribution, which again is not obviously purely to be welcomed to the extent it means limited real exchange rate adjustment. But the fact that inflation on the average has been low is also relevant. Next slide, please. So then the next set of basic distributional graphs on the left side shows the external account, the current account balance. And what it shows here, again, the basic message is in the first decade of the euro, we had a very wide dispersion. The large surplus countries, but also countries running large deficits, including Greece, Portugal, Spain, and Ireland to different extents. And then what we've seen since then is in the most recent period, on average, the euro area has now moved into a current account surplus. And that chronic current account surplus for the euro area aggregate as a whole has a range of implications. But what's interesting maybe is there's still at a country level significant surplus countries, but by and large, no country is running a large deficit. Now, again, I don't say this is optimal, but what is true is that the tail risks associated with large current account deficits, that tail risk has diminished over time. On the right side of the same chart, I do a similar calculation for the fiscal balance. And what you see here is that during the crisis years, average deficits did increase. And you also had a very large range of variation. So of course, during the crisis years, when you had very large deficits in some countries, other countries closer towards balance or even positive, again, the dynamics of fiscal debate in Europe is very constrained by that. And what we saw after the crisis is again, a strong convergence in fiscal policy. And I stopped the chart here in 2019 because, of course, the pandemic is different. So in other words, there was a big fiscal adjustment after the crisis, which had various macroeconomic costs. But again, in terms of the tail risk of having member countries with large deficits, that tail risk did diminish after the crisis. Next slide. Now, so far I've focused on flow indicators, but it's important to also examine the balance sheet. because we know stocks of debt also matter for vulnerability. And what you see here is that there was a big correction in debt to GDP ratios after the crisis. So again, the determination to reduce fiscal debt ratios did materialize after the crisis. Again, not pain-free by any means, but bottom line is the lowering of the debt ratio did reduce vulnerability compared to the peak of the crisis. And on the right side, it's showing private sector debt. And essentially, even though the graph is a little bit, maybe the markings are a bit light in the markings, the basic message is, again, the tail of that distribution came in. The countries with very large private sector debt, those private debt sector ratios came down. There's a lot of deleveraging in the private sector. So the basic point is 2014 to 2019, we had a big improvement in macroeconomic indicators. Again, that has macroeconomic costs, but in terms of vulnerability, there was a big improvement. Next slide. So here on the left side, I look at because of course, when you think about the external account, it's the sum of private and public that matter. And the external account is again showing that the levels of net external debt converged, so much less by way of very high readings in this period. And then on the right side, I turn to the resilience of the banking system. And what you see here is a big increase in the capital asset ratio for the European banking system. So again, the key vulnerability, the doom loop vulnerability of having banks with not enough capital to withstand shocks, there's a huge improvement over that time period. Again, often in a very painful manner. Okay, so so far I've showed you various quantities. The next slide shows you a key summary indicator, which is the 10-year yields. And what you see is compared to the very high values we had at the peak in 2012, although there was some fluctuations later on, especially of course in the Greek case, the big story here is the narrowing of spreads and also the fact that the level of spreads, the level of yields is very low. So both have happened, low level and low dispersion. And of course, the resilience of the euro is a lot stronger when essentially you have a lot of stability in the sovereign bond market. And in terms of stability in the sovereign bond market is the platform for stability in funding costs to the private sector as well. So that, if you like, is my empirical description that all of these fragility indicators that people look at, when you think about the euro area, there's a big improvement after the crisis. And so a lot of sacrifices were made to make the euro area more resilient. Now, in going beyond that kind of macroeconomic data review, it's important to also think about the institutional environment, the architecture question. So maybe if you go to the next slide. Is that resilience is also about, do we have the architecture in place to prevent crises and to manage crises? So we know that there was a missing piece of architecture going into the 2010 episode. And the fact that we now have the European Stability Mechanism is so important. Now, ex post is important as a source, as a way for the European Union to organize official funding to the various program countries. But the longer term role is ex ante. The fact that it exists, the fact that it has allocated funding is a permanent calming force. Because the multiple equilibrium problem, where a country that suffers a negative shock, where investors get nervous, that other investors will get nervous, and there's a self-fulfilling increase in yields. One necessary element in containing that risk is the availability of official funding when needed, and of course subject to conditionality. So that, if you like, was so important at the time. And I suppose, let me emphasize, the way to think about the ESM is not through its active lending, because if such a mechanism is totally successful, it's never used. It's there as a backstop, and as a backstop, it acts as a calming force. In turn, with the ESM, if you like, taking care of solvency concerns, again, subject to all of the steps in that solvency process, and as a provider of official funding, that unlocked the role for the ECB to provide liquidity through the OMT program. And again, it's the fact the program exists is the most important characterization. And as we all know, OMT has never actually been used. But again, the calming force of having a stabilizing mechanism as a backstop is so important. But to emphasize, any central bank needs another agency, a fiscal agency, to play the solvency role. And so with the ESM taking the solvency role, then conditional on the country having an ESM program, the liquidity dimension can be managed by the ECB. Let me emphasize, in terms of preventing financial crises, a very important reform that actually was implemented over these years was the rollout of macroprudential policy. And by the way, we've seen the value of this during the pandemic crisis. By limiting leverage to households, in many cases through loan-to-income and loan-to-value ratios, limiting the leverage of banks by increasing capital asset ratios, and in some countries, limiting the leverage to corporates, essentially this has reduced vulnerability. And when we went into the pandemic shock last year, the fact that leverage had upper limits on it definitely acted as a stabilizing force when the pandemic hit. We also have made major changes in terms of banking regulation and supervision. So in addition to the higher capital asset ratios, the fact we have a recovery and resolution directive, the fact we have a resolution mechanism, including the pan-European level through the SRM, is so important. And the fact we have pan-European supervision for banks through the ECB and through the European supervisory agencies, again, takes away one problem in a crisis situation, which is potential for deviation from European standards by national supervisors. And then finally, we've also had the reform of how national fiscal policy is implemented with this kind of monitoring role for independent fiscal councils, a very important role, I think increasingly successful, from the European Fiscal Board, and the whole mechanism of the European semester. Next slide, please. So I would say this is not complete. All the time, many institutions are involved in trying to work out how we can make progress on banking union, whether through European deposit insurance or also more generally ways to promote pan-European banking. There's a parallel desirability of more by way of capital markets union. And for many people, there's a interesting debate about central fiscal capacity. Let me emphasize the debate about central fiscal capacity, which is a modified version of fiscal union, is there was definitely a period of time when the focus was on risk sharing for asymmetric shocks. So if one member country was in difficulty, other member countries could provide fiscal assistance in a risk sharing mechanism. In fact, the other element has been proven to be more important last year, which is when we have a common shock, such as a pandemic, having a central fiscal capacity in the form of next generation EU turned out to be very important. Now, of course, as a matter of logic, you can also imagine a potential role for central fiscal capacity in dealing with international public good problems, such as fighting climate change. Next slide, please. So what I mentioned was, it turned out the pandemic has led to a new wave of architectural progress for Europe. In the first set of responses, I think quite a nice initiative was the issuance of these Sure bonds, which is issued by the EU, but then basically on lent in traditional lending format to the member countries to deal with the surge in unemployment. That was, if you like, very successful. You had the ESM pandemic contingent credit lines. They've not been taken up, but again, the more important role is to act as a backstop. We have the European Investment Bank offering credit guarantees for firms. And so that triple lock of different rapid rollout responses were important. But of course, the real game changer was later in the summer with Next Generation EU, because of the fact we have these jointly issued bonds, which includes a grant component to national governments. Now, again, that's hand in hand with the recovery plans, which include reform agendas, which again reinforces the impact of this. Again, this provides medium-term spending support for the next number of years, and its funding is long-term, which makes sense in the context of spreading out the costs for pandemic shock. So let's see where we are with this. But if you like, I think the world's investors have interpreted this as a state contingent central fiscal capacity. Maybe the only state of the world is a pandemic, but even dealing with a pandemic, that's relevant. But again, depending on the success of how it's rolled out, maybe that model where we have a standing facility that can be invoked for large common shocks could be interesting. Let me emphasize, in addition to the actual spending from this money, it had an immediate impact on risk premia. And this was very important last year in stabilizing financial conditions in Europe. And the timeline of the compression of risk premia in Europe is very connected to the announcement of Next Generation EU. Okay, next slide. Let me emphasize, in the paper I tried to go through this a bit, which is to some people, when they look at the euro, they're a bit puzzled, saying, why has there been such commitment to a currency? And of course, a very basic answer is that it's intertwined with the resilience of the EU in general. That the euro is the currency of the EU, and it's maybe a bit artificial to construct scenarios where countries would take a different view to the euro to their overall membership of the EU. I would also point out, just empirically, that of course, after the UK has left the EU, the overlap between the EU and the euro area has gone up quite a bit. And of course, with the applications of Bulgaria and Croatia, the overlap between the EU and the euro area is only going in one direction. So the kind of identity of the euro as the currency of the EU is, I think, very important to understanding its resilience. And then in the paper, I tried to argue that we know international economic policy has many trilemmas, many trade-offs. So there's the trade-off between independent monetary policy, capital mobility, and a fixed exchange rate. The international financial trilemma is the trade-off between capital mobility and national approaches to financial regulation. And then the international political economy trilemma is it's very difficult to run a global approach to the financial system and monetary policy if politics are purely local at the national level. And my conclusion in the paper is essentially the European Union and the format of the euro says it's not, rather than asking you to choose a corner solution, maybe a hybrid solution where you try and reconcile these trilemmas is superior. Now, it's messy. So if you don't have corner solutions, it's messy because there's perpetual push and pull tension between centralization and decentralization forces. And this is why hybrid solutions where ECB itself, of course, is a hybrid between the role of the ECB and the euro system. Fiscal policy is a hybrid between national fiscal policies and the limitations imposed by the European semester and now this central fiscal capacity. But maybe it's not terrible to have these fuzzy solutions, even if it's more difficult to understand sometimes. Okay, next slide. Okay, I think rather than dwell too long on this, especially since I hope you download the paper and read it, let me just restate my conclusions. Is that we, even by the end of 2019, we've seen a lot of improvement in the resilience of the euro, both because of the fact that the policy, if you like, the policies have been more supportive of convergence, the fact that there have been fewer asymmetric shocks in these years than in previous years, and also because of architectural reform. I've also emphasized the pandemic itself has led to a leap forward in the resilience of the euro through to the implementation of next generation EU. But I'm also emphasizing for the future, let's not be complacent. Banking union is not complete. Capital markets union is not complete. The single market for goods and services is not complete. And then I'd also emphasize common shocks like a pandemic are maybe easier to handle than asymmetric shocks. And we cannot rule out asymmetric shocks in the future. So any evaluation of the resilience of the euro has to remain quite conditional and qualified. So with that, let me stop, and I look forward to the other contributions and the exchange.
Thank you very much, Professor Lane. Let me now give this was an extremely interesting overview of the resilience of the euro, and one comment I would like to make, but I will state there is that even symmetric shocks can sometimes have asymmetric effects in between, say, the center and the periphery of the euro area. But I'm sure that that you would count those as asymmetric shocks. So let me now give the floor to Professor Helen Louri. Professor Helen Louri is a professor at the Department of Economics. She was a previous head of department, and also between 2008 and 2014, she was the deputy governor of the Bank of Greece. So she has a lot of experience before and after the crisis. So Eleni, please, the floor is yours.
Thank you. Well, first, I would like to thank Professor Lane for his illuminating and optimistic presentation on the resilience of the euro. I found very pertinent and educating the grouping of phases of euro's life into the one-off learning phase of 1999-2007, the extended crisis phase of 2008-2013, which unfortunately for Greece lasted until 2015, and the recovery phase of 2014-19, followed by the pandemic phase. Having lived in Greece during most of these turbulent times, I couldn't agree more about the euro being a political project supported by the strong political commitment of its members to remain together as the only plausible way to the future. Even in Greece, which lost more than a quarter of its GDP and saw unemployment exceeding 27% in its protracted crisis phase, the approval of the euro, according to the most recent Eurobarometer of March 2021, is 70% versus an average 80% in the euro area as a whole. So the euro proved resilient. Its architectural construction has been improved with many important innovations: the ESM and the OMT in 2012, the three-pillar-based European Banking Union with the SSM in 2014, the SRM in 2015, and the still negotiated EDIS. As for the recent response to the exogenous and mostly symmetric pandemic crisis, with the introduction of advanced joint, almost federal measures, such as the SURE initiative, the Next Generation EU, the European Investment Bank guarantees, producing commonly backed Eurobonds that approach 10% of euro area GDP, if we also take into account the ESM debt, potential debt, it has certainly been impressive. Of course, there are still missing elements, and I would like to ask you about some of them. Do you believe that the current bank crisis management framework is robust and or adequate? The resolution approach for failing or likely to fail banks being based on the bail-in tool is efficient? Or maybe it has become too costly. Minimum required eligible liabilities, even for medium-sized banks, reaching 26% of risk-weighted assets, on top of capital adequacy of close to 18%, is a costly financial stability requirement. However, small and even medium-sized banks are not equipped to tap markets in order to issue MREL instruments. How should they proceed? European banks suffer from low profitability, which then deters them from more lending and creating growth. Do you believe these costly resolution requirements contribute to the low profitability problem and the subsequent low growth we've seen even in the recovery phase, as some banks complain? Then the European Deposit Insurance Scheme, indispensable for financial stability, has been bargained for so long without reaching a final agreement. Greek banks lost half of their deposits between 2010 and 2015 due to the contemporaneous existence of free capital movement and lack of a common deposit guarantee. Banks were drained from liquidity, and this amplified the horrifying recession that followed in Greece. EDIS was originally envisaged as the third pillar of the banking union, but it is still not there. In combination with the SRF, EDIS could also help with dealing with bank resolution, the second pillar. A move from the current national deposit guarantee schemes is necessary, maybe in a gradual manner and a medium-term horizon for the next, say, 5 years. How do you see the EDIS prospects developing? Finally, inflation dynamics is a question in everybody's mind after the generous and necessary interventions of the ECB and the Commission to counteract the pandemic crisis effects. Do you think there is a threat for the medium term? I think I should stop here. Thank you very much.
Thank you very much, Professor Louri. Philip, I would suggest that you can answer directly, or we can give the floor to the other two panelists, and then you can give a more general. It's up to you.
Probably it might be efficient if I listen to all of the contributions and then I can respond. Yeah.
Okay, great. Thanks very much. Okay, let me now give the floor to Professor Plutarchos Sakellaris, who is a professor at our department, but he has a lot of policy experience as well. He was the chairman of the Council of Economic Advisors between 2004 and 2007, and then he was the vice president of the EIB after that for another 4 years before he returned to his academic duties. So again, he has a lot of European experience, and during the good times of the euro and the bad times of the euro. So Plutarchos, the floor is yours.
Okay, thank you very much, George. Well, let me also thank very much Professor Lane for coming to us, even if virtually, and speaking to us about this very dear topic to all of us here. I read obviously your paper, very interesting paper too, and you did a great job summarizing it here. I wanted to focus a little bit more on the nature of the shocks that we just received and the nature of the shocks that are likely to come in the near future, because a lot of the, not victory chants, but let's say satisfaction about how resilient the euro has been and how well the euro system has functioned over the last year and a half and so on, is based on the response to the pandemic. And indeed, the response to the pandemic has been quite successful by European standards, and certainly has moved forward the architecture in ways that we could not have imagined before that. But the nature of that shock is as purely common as one could possibly have not even imagined. So the fact that it was so common, it was absolutely common, was what led to, in my opinion, to the suspension of the fiscal rules, which basically gave all the latitude to local fiscal authorities in order to deal fiscally with the crisis. It led to the introduction of this central fiscal capacity through the SURE, as you just said, and through the Next Generation EU Fund. And also, it allowed the European Central Bank to do what it takes, which was PEP, the PEP program, which was so much helpful and needed. So because of that, I think the political economy of that shock being common, the political economy worked so that all the actors took that important and brave step forward. Now, looking forward, and it's not that you're not aware of it, in fact, you mentioned it towards the end, there are some potential risks to the global economy and to the Euro and EU economy that even though they may not even though they may be of global source in nature, they may not manifest themselves as common shocks. And the main thing that I'm thinking of, and you alluded to in one of your slides, is climate risk and the disasters that come with it. So what climate risk is, because it's an international public good, it's certainly a common problem. And one could think that the source is definitely common. But the way that it's going to manifest itself around the Euro area countries is not going to be common. And we are seeing that already. And over the medium term, I don't know how many years that will be, the kind of economic impact that it will have will certainly not affect all Euro area economies at once. So the question there is, certainly right now, we do not have the capacity to deal with it in a coordinated and central manner. And the question is, can we bring that capacity in terms of automatic suspension of fiscal rules for the countries that are affected by this common, unexpected, but not asymmetric shock? Can we have a fund that is similar to SURE and to the Next Generation EU Fund that will be able to take care of the individual few countries, not all 19 or 21, however many we will be in the future, who might be affected by that. And of course, the third thing is, how can we prepare our banks to deal with that? Now, on the third leg, the ECB and the SSM are doing a lot of work on this by already considering issues of ESG and seeing how they can incentivize banks or penalize banks to move away from brown finance towards green finance. And there I would like to have your comment on possible introduction of rules either on the first pillar or on the second pillar that will help towards this aspect of the fight of climate change. But I wonder whether you think that it's possible that we will have anytime soon this kind of coordinated central either fiscal capacity for this kind of disasters or economic risks, or even centrally coordinated relaxation of fiscal rules. If we do not have that, then we are suffering possibly a form of instability, which we have to think about it already. We have to think about, if you don't have the ability to suspend fiscal rules, then you have to make sure that that you study which countries have the highest risk to be affected by climate change and institute specific fiscal buffers, for example, differentiated by country in those countries. So anyway, to sum this up, in a way that you also alluded to, it's not entirely clear that looking forward, we are looking into more common shocks. We did a great job when the shock was common. How optimistic are you that we will have this sort of reaction or other preparation for this reaction, even when the shocks are not so common. So this is, and it opens up a lot, and it gives you the chance to comment a lot on that. But on perhaps you can also address the specific question of how, in terms of either first pillar actions or second pillar actions or changes, the EU banking system will become more resilient to these sort of risks. Again, thank you very much.
Thank you, Plutarchos. Let me move on directly to Professor Vettas. Professor Vettas is another distinguished member of our department. He's currently the head of the Institute of Economic and Industrial Research, which is the top research institute in Greece. He has a lot of policy experience in the last few years. He was also one of the main editors of a very important book that came out a few years ago called Beyond Austerity, which studied the economy of Greece after the adjustment programs of the early 2010. So he has, again, a lot of experience on these issues. And Nikos, we are looking forward to your comments.
Thanks, George, for the opportunity, and of course, Professor Lane for the lecture and the insights. There is a lot of information and very useful perspectives in the article and your lecture. I am a microeconomist, so I'm going to focus more my questions and my comments on that side of the discussion, and in some sense, on more of what is left out of your analysis and perhaps worries me down the road. There is a number of ways to ask the question about the resilience of the euro. One specific question is, so was the euro a bad idea in the first place? Was it a kind of suicidal project ending nowhere? And the answer to that is no. There was a way to handle the difficulties, and there were severe difficulties, but the euro was not a bad project. There was another question, which was euro a bad idea for the weaker economies? And that's a more complicated question, but still the answer there is probably no. It was not a good idea. It was not a bad idea for the periphery to join. And we found ways to eventually put things on track. Then there would be a question like, under the euro regime, was policy successful during the 2008 crisis? And there I would say the answer is probably no, it wasn't that successful, at least initially. Then there is the question, is policy currently successful with the new crisis? And the answer is probably maybe. But what I would like to think about is specific micro aspects of what the euro may be reflecting. I'm going to be brief, of course. One question has to do with the three elements of what build production, which is obviously capital, labor, and productivity. And one thing I guess we didn't have the time to touch upon is how the Eurozone compares with other developed parts of the world. It might be a wrong impression, but it looks like the US and parts of Asia are coming out of the current crisis much stronger and with more flexibility and higher competitiveness than the Eurozone. Of course, this is not a conclusion yet, because the current crisis is not even over yet. However, this might not be a monetary policy issue, but we might need to be concerned, despite the fact that we have all these policies of the ECB in conjunction with now Brussels also responding with the next generation EU, and yet the Eurozone economy appearing, less flexible than other parts of the world might be a reason for concern, maybe not for the ECB itself, but certainly for the governments. So in terms of the three areas, capital, you mentioned it already at least a couple of times, the need to deepen, to proceed with the capital markets union. I would like to put two side questions here. One is in the Eurozone, Europe more broadly, but the Eurozone in specifically, in the Eurozone, we have a much higher importance and weight of the banking system than there is in the US and in Asia and in other parts of the world. And this hasn't really changed much during the crisis. Is this something that should worry us? Is the fact that other channels of finance do not operate as effectively something that is consistent with the need to go to a more productive economy, with the need to have a more balanced allocation of risks? At the same time, the banks, as already mentioned before, they have their difficulties. So if we cannot make our banks exactly as we want them, in other words, perhaps we should have something stronger besides the banks and in a complementary role with the banks. That's one question. The second question is if, to some extent, we are seeing some revival of the sovereign and banking nexus that was part of the problem back in 2008 and in different ways now, but under the general agenda that monetary policy should ease uncertainties, maybe we're putting so much cortisone in the system that we are distorting some incentives again. So how are we going to backtrack and have the balance sheet of the ECB get towards, gradually of course, towards a more normal, if the word is acceptable, position? Finally, two questions about, it's related again with productivity and growth. We seem to continuously have, and that has not changed over the years, if I'm not mistaken, a less effective functioning of labor markets in Greece. Of course, labor markets functioning well and mobility across economies is one of the prerequisites, I guess, in the textbook, optimal currency areas. Do we see this? Do we see, for instance, any even idea for some common unemployment insurance, for some alignment across insurance systems that might be a prerequisite for labor mobility? How should we think that labor mobility is affected, but also is affected by the presence of the euro, the common currency? So effectively, I'm asking from a microeconomist viewpoint, yes, the euro is bringing credibility. However, one needs to ask to what extent the micro incentives created are uniform and strong enough across economies. To put it differently, Greece, for sure, and some other countries that needed to be rescued after 2008, for sure Greece, I don't want to talk for others, we found ourselves in a very difficult position where basically if you have a strong currency, you lose some competitiveness, but at the same time you have credibility. And the Greek economy for a number of years was with a strong currency, but without credibility, because there was the question mark as to whether Greece should be in the Eurozone. This same mistake was not repeated in the new crisis. However, there is a longer run, and I'm concluding my remarks with this, there is a longer run question, which is a political economy question. how much sense it makes to have a strong currency if you don't have strong institutions. And of course, the incentives are for the European, should be actually for the European periphery to have strong institutions, but that's kind of a political economy question. Should we expect that going back to a less marginal monetary policy will push policymakers in national economies do the right thing? Will the next generation EU be enough? So these are additional questions. I'm ending here because I sense all three of us, we have accumulated too many questions for Professor Lane. But it is super interesting to think down the road how policies related to the euro can affect the three areas of productivity, labor force participation, and capital markets that eventually are going to make the European economy stronger. So just to thank again Professor Lane, and I'm sure we'll be hearing from him and his group at the ECB and other collaborators down the road. Thank you, George.
Thank you, Nikos. Philip, what I propose to do is to give the floor to you to answer some of the issues that have been raised by the three discussants, and then there are three more members of the department waiting to put their questions, Professor Philippopoulos, Professor Pagratis, and Professor Dikitopoulos, but they will speak after you have answered these initial remarks. I would just like to add one question that came up from the chat on YouTube, and the question is a very topical one. It says, will a digital euro affect the stability and resilience of the currency, and how? So I will with this additional question, I will ask Philip to come back to us with his thoughts.
Okay, thanks to everyone for a great set of reflections and comments and questions. And, I think, if you like, it turned into quite a nice seminar format. So I think a lot of these issues, no doubt, we'll all be coming back to many times. I mean, what's interesting in terms of the correct design of the financial system and the issues about resolution is I think we all have probably in general, there's a very high shared vision for what you would do in steady state. So in steady state, or again, if you rewrote history, what you would put in place before launching the currency. And for example, of course, in steady state, for the reasons that you gave, having full-scale EDIS would be very natural. And we know, looking at the differences between regional dynamics in the US and regional dynamics in Europe, the fact essentially you do have a federal banking system in the US makes such a difference. Absolutely. But of course, the issue is how do you go from here to there? At one level, there's huge progress in risk reduction in recent years. But of course, there's remaining concerns. And of course, when public debt ratios have moved in the opposite direction during the pandemic, that debate remains about the correct transition speed. But what is important probably is to maintain that vision. We know where we're going to end up. We know where we're going to end up. And of course, there's a big political process to get there. So the idea of MREL and related ideas, I mean, I think there's always a global debate about where you draw the line in terms of scale. So is it the case that the right regime for very large banks should also be applied to smaller banks in terms of proportionality? So, I mean, I think the issues you raised are very pertinent, but I'm not particularly involved in those debates, so I don't really offer any comment. What I would say, Gordon, you also asked about inflation dynamics. I've been consistent in my view, which is right now it's overwhelmed by transitory forces. Inflation in 2019 was low, sorry, in 2020 was low. because of various initial impacts of the pandemic, plunge in oil prices, VAT cut in some countries, other reasons prices fell last year. And as we're coming out of the pandemic, a lot of that is in reverse. So high inflation this year, to some extent, is just cancelling out low inflation last year. And if you average the 2 years, inflation in the euro area, I think will average around 1%, which is where it was before the pandemic. Now, of course, there's also a global debate about global commodity prices and so on. Let's see. And of course, for Europe, the medium-term inflation dynamic can only be discussed in the context. Right now, we have unemployment, whether official and including job retention schemes, around 15% of the euro area. So it's very difficult to have really strong wage inflation when the labour market is in that condition. So we do think inflation will go up at a steady pace over time, but the idea that there's some new paradigm, I don't really buy into that. The issue, some of you have already made this comment, is even a common shock kind of asymmetric effects. So, of course, the pandemic, it affected those countries with big tourism sectors, in particular, different to other countries, that's for sure. But of course, Next Generation EU is designed a little bit to counter that. So in fiscal policy, you can allow for that asymmetry by, of course, the allocation of grants has been conditioned on who was hit hardest by the pandemic and also by initial income levels. But what I would say is also with asymmetric shocks, a very important issue, and this is where policy, national policy in particular, plays a big role, is vulnerability. Obviously, a given shock is more destabilizing the more vulnerable you are. I suppose what I was trying to say in the data part of the paper is vulnerabilities come down. Current account deficits a lot smaller. So the dynamic where you get that kind of loop where a negative shock raises risk premia, global investors get nervous and you get a sudden stop in the economy is less likely if the current account deficit is low. A similar vein for fiscal policy, the ability of Europe to respond to the pandemic was strengthened by the fact fiscal positions were relatively contained pre-pandemic. This is where macroprudential policy is so important. The fact that many firms and households had relatively limited leverage going into the pandemic reduced vulnerability. So what I would say, and it's an interesting question, is, and I fully recognize what you said about the new type of asymmetry with climate risk. That's totally visible, and any geographic analysis of climate risk clearly finds asymmetries across the area. But let me sidestep for one moment that kind of physical asymmetry. A phrase I did use in the paper is that the first decade of the euro was a learning episode. That even though ex ante in the 1990s, many risk factors were identified, the importance of reducing vulnerabilities was discussed. Unfortunately, many of those lessons were not implemented in the first decade of the euro. We had a very painful lesson with the crises, especially in those countries hit hardest. And I suppose the big question is whether those lessons have now been learned. So whether the imperative of containing vulnerabilities, avoidable vulnerabilities in terms of policy imbalances, will be maintained into the future. Now there are less avoidable vulnerabilities where climate risk is clearly one. And the issues you raise are important there. But analytically, this is an analytical point, is we know in relation to natural disasters, including physical disasters, quite often there's an ability to smooth out the impact of that through international adjustment. So there's a high correlation between natural disasters and current account deficits, for example. Countries borrow to smooth the cost. There's a difference when it's not a kind of temporary shock, where it's more of a chronic, permanent shock. So countries which have to face increased temperature risk, wildfires, floods, whatever it is, Is that a smoothing challenge, or is it simply a permanent loss of income? You have to allocate permanently more of your income to mitigating that damage. And of course, in a risk-sharing world, there'll be international insurance to compensate. And that's a big question for Europe, is that balance between smoothing versus compensation, if you like. And so the right design of the fiscal institutions clearly depends on that. And then the questions you asked, it's interesting what we call micro versus macro, because even though I'm a hardcore macroeconomist, I would think all of your questions are very relevant for macro as well. I mean, what's interesting on the bank versus non-bank question is what is optimal? I mean, I do think directionally there's been a rise in non-bank financing in the last 10 years. And we know, I know it's relevant in Greece and in Ireland for that matter, one basic engine of that has been the transfer of non-performing loans to non-bank investment funds. So the risk associated with those non-performing loans has been transferred out of the banking system. But that's very limited compared to other roles for non-banks. The big questions here are about the demand and supply of non-bank finance. One is a lot of non-bank finance is really only relevant for large firms. And until we have more of a single market in Europe, until we integrate more of the markets for goods and services, the scope for having large firms that might tap the bond market or tap the equity market is limited. So to me, the deep foundation for a larger capital market is going to be much more scope to have large firms in Europe. And then on the other side of it is the provision of non-bank finance. Are there institutions in Europe of sufficient scale to provide equity funding, bond funding? And this goes most obviously to how pensions are financed in Europe. So those who look at the comparison between the US and Europe often come back to a pretty basic factor is so much of retirement income in the US is financed privately, so whether through a corporate plan, whatever, but not pay-as-you-go state pensions. And so it's a question on both sides of that. The supply of non-bank finance, demand for non-bank finance. On top of that, of course, you need the right policies in terms of capital markets union, but those are big fundamentals. I mean, what's interesting with the pandemic, and this is a very general comment, is that we've had big increases in fiscal deficits, but this has not spilled over into current account deficits. So it's very different to previous episodes because the counterpart to large fiscal deficits has been high household saving. And the macroeconomics of sectoral imbalances, but no external imbalance, is very different. And if you like, there's an inbuilt automatic adjustment here, which is as the economy recovers, you have an increasing in tax revenues, you'd have the kind of termination of pandemic expenditure programs. But from a macro point of view, the reduction in fiscal deficits should be offset by reduction in household surpluses as consumption recovers. So, you know, the fears that there's going to be a huge macro adjustment problem, you know, there are reasons to believe it's less severe under this configuration. I mean, I do think lots of people should continue working on the scope of a common unemployment insurance, because there it's possible, I think, to design schemes that satisfy, you know, it's in everyone's interest, you know, and there's lots of schemes out there through reinsurance, copay and so on that they can get there. I would highlight an interesting point, which is again for maybe a whole research agenda, which is going back to the 1960 literature. From the point of view of an individual, of course, labour mobility is win-win. The option to move in response to an asymmetric shock from an individual point of view gives you an extra option. Of course, people find it costly to move from their home country, but we've seen a lot of mobility across Europe. But that is not the same statement as to say it's in the collective interest of a given country to tolerate high emigration. Because of course there's a big dynamic there if you have a lot, for all sorts of reasons, both macro and political. So that's an interesting question about the micro perspective versus the wider policy perspective about the role of mobility in the euro area. Very interesting question about whether common currency makes institutional reform more or less likely. It's a big question. I mean, there's people who've got to take opposing views on that, but I think it's so important. But what I would say, going back to my paper, basically, is a lot of reform has happened. Without the crisis, I mean, in terms of how we do fiscal policy, macroprudential policy, banking supervision, many things which were probably red lines 20 years ago have moved. So the actual level of institutional reform, now at a policy level, I'm not disagreeing, other types of institutional reform have not happened. But I would say maybe someone called me an optimist earlier on, and maybe I am. But I think there's a lot has moved. On the digital euro, we should be emphatic about this. We're looking at it, we're investigating, but I'm pretty sure any digital euro that we would look at has a lot of safeguards to avoid the obvious financial stability concerns. So it won't be, if you like, a kind of carefree attitude to the digital euro. Any digital euro should be interpreted as coming with so many safeguards that financial stability risks will not be concerned.
Okay, thank you very, very much. Let me go to our final round, which is a few questions from. There's this question about the digital euro, right? That we shall come back to. But let me ask Professor Philippopoulos now to take the floor, and then Professor Pangratis, and then Professor Dikitopoulos following to put their questions. Apostolis.
Thank you, Professor Lane. Thank you very much for your time and your lecture. Very, very informative, very educational. I would like to ask you, if you don't mind, a question on the policies and the role of the ECB during the sovereign debt crisis, the global financial crisis, and then the sovereign debt crisis. My understanding is that conventional policies, like interest rate policies, for instance, can work symmetrically across member countries. But on the other hand, quantitative policies can work, let's say, asymmetrically, in the sense that they differ across countries and therefore they can address different problems. And I think we can see that if we just look at the financial statements of different banks, for instance, the Bundesbank, the Bank of Greece, etc., they look completely different. So it is natural, I mean, I don't know, as not from a policy view of policy making, but as an academic at least, it is natural to think that these policies are redistributive. That is, here by redistributive, I mean, they implies a kind of fiscal redistribution, if you want, although they are monetary policies. And I suppose an example of that is target 2 balances. I mean, they are huge and hugely positive in some countries, hugely negative in other countries. I mean, especially during the sovereign debt crisis. So I wonder if you agree with this interpretation. I mean, I understand if you can at least give me some feedback as an academic, at least, not an official view on this issue. Thank you very much.
Okay, Spiros Pangratis, who's an expert in finance, another prominent member of our department.
Thank you, George. And Professor Lane, thank you very much for your time, for this opportunity, and for the immensely illuminating talk. Possibly touching upon previous questions, and in particular also Professor Philippopoulos' question. What are the specific challenges you see in terms of favorable financing conditions in a multi-country monetary union when the banking and the capital markets union remains incomplete? That's one thing that I'd like to ask, mainly because also touches upon my main interest of banking and financial institutions recently. So, and the second question, if I may, whether do you see the possibility of normalization of macro policies occurring at different speeds across the Atlantic? Thanks a lot.
Okay. Professor Dikitopoulos.
Hello, everybody. Professor Lane, thank you very much for your time and your great talk. I'm going to touch upon some questions. Specifically, Professor Alogoskoufis told about the asymmetric effects of a common shock. So we have seen that the common stock has asymmetric effects, and this is a challenge for the euro area, as according to macroeconomic modeling, can trigger multiple equilibria between different countries. And we've seen that the literature talks about institutions, different fiscal policies. However, from a little knowledge, little work has been done on the behavioral differences between European citizens. You know, a lockdown measure, according to Google mobility data, has completely different effect on Italy or in North Europe. So there are behavioral differences, and thanks to a paper in the QJE, we managed to quantify now these differences, like time preference, level of risk aversion. And, you know, in macroeconomic modeling, we set parameters to match the data, the model data. But usually for these preference parameters, we set them the same. So my question is whether, you know, the ECB can take into account these cultural differences in the transmission mechanism of monetary policy, so we can quantify that and understand and predict the asymmetric shocks better. Thank you.
Thank you very much, Evangelos. Before this final round of answers from Professor Lane, there is another question from the chat, which again seems to be on cryptocurrencies and the like. The question is how the economy would work if no one would control inflation in a case like cryptocurrencies, for example. So if you have any thoughts on that, Philip,
okay.
One of the people who watch would appreciate it. Okay. Thank you very much.
So again, a great set of comments and questions. So even though it's online, I think we replicated a nice seminar format. I mean, what I would say, and it's difficult to overstate this about the target 2 imbalances, is, let's be clear here, it is fundamental to a monetary union that we have a unified liquidity system. And, you know, and the ECB has published, I think the most recent was maybe 2019, a nice occasional paper about over time the different fluctuations, the different sources of fluctuations in target balances. But the only thing I would advocate is anyone who looks at these just thinks hard about what's going on underneath, and to reflect on the fact, if we have a monetary union, we will have some version of a target 2 system. And actually, when you go back and read text, I mean, I'm pretty sure if you go back and read any academic textbook, it's going to be silent on this question because it's not a first order issue. Conditional on having a monetary union, it's not a first order issue. What I would say is maybe coming to the banking and financing conditions and favorability is, you know, one element of the whole pandemic, of course, is the concern that many firms have lost so much revenue from the various types of shutdowns. You know, and of course, what's happened is there's been a lot of fiscal support, all sorts of types of fiscal support, whether direct to the firm or because governments have, through different ways, subsidized workers or have subsidized credit through guarantee schemes, that a lot of that vulnerability has been contained. But that's an ongoing question, you know, especially as you get to the other side of the pandemic, that we do think this is something that we have to look closely at. But what I would say is, compared to some initial concerns, the scale of the fiscal response has really addressed this in a very large way. I mean, throughout the afternoon, we've come back to the fact that a common shock can have asymmetric effects. And there's all sorts of reasons for that. And it's very interesting, again, when you try and write down a model, how to think about that. Because, I mean, I suppose I basically agree this is important. Because the amount of times you have a pure asymmetric shock is maybe limited, whereas the amount of times asymmetries in economic structures, asymmetries in basically inherited positions, whether asymmetries in external imbalances, fiscal imbalances, and so on, do create different responses. I mean, by and large, of course, how you address these asymmetries will need to be through different policies, not through monetary policy. On this interesting question about behavioural differences across countries, I mean, by and large, you know, I think the more we understand the differences across countries, the better able we are to calibrate our monetary policy. There's only one monetary policy for the euro area. So, but when we think about the euro area, we of course need to aggregate or have consistency with the aggregation across the member countries. For those of you who don't know, our forecasting process basically goes in both directions. There's a bottom down or top down forecast based on aggregated data, but there's also the bottom up forecast, which basically aggregates across the national countries. So at that level, it's interesting, the robustness of doing it both ways does allow us to take into account, because we rely on the expertise of the national central banks to take into account local differences. And absolutely during the pandemic, that was actually very important. Because, you know, remotely from Frankfurt, understanding the details of what's going on in different countries is not so possible. So, of course, I think we can have deep discussions about, are there truly fundamental differences in time preferences across countries? And how do you tell that apart from maybe less deep but still relevant applied differences, maybe because of differences in culture, education? It depends what you hold fixed in that question. So I think, and also same for risk aversion. So, you know, I actually, and let me highlight something we now have at the ECB called the Consumer Expectation Survey, which we're trying to roll out to more and more countries. Because the goal is to have a survey every month, or very frequently, which surveys across as many European countries as we can to take into account the differences in behaviour across individuals. So at one level, of course, the national differences are important, but there's other cuts of the data, not just national. Age group, education, gender, high skill, low skill, lots of reasons why we want to allow for differences across individuals. So maybe I've forgotten some issues there, but and maybe could come back to target 2 because maybe I'm pronouncing is that how we think about cross-border flows. So whether that's private sector flows or flows within the euro system, you need to do an integrated analysis. But it is an intrinsic part of a common currency, a common central bank, that we will have cross-border liquidity flows. So let me stop there.
All right, thank you very much. I think we have made it on time. I think we will stop here. On behalf of everybody who participated in this discussion, let me thank Professor Louri for accepting our invitation, for being so patient with us, and for illuminating us with his both his initial remarks and his answers to questions. Thank you very much, Professor Louri. We really appreciate your presence in this event.
Well, thank you all so much. It's a very interesting afternoon, and I really appreciate all the questions, and I hope we can maybe have a repeat event in person at some point. So,
well, we hope that the pandemic will be a forgotten memory sometime soon, and then maybe next year we can get you to come to Greece and talk to us in person. Thank you very, very much.
Yes. Bye.